Imagine owning a sunny Florida condo for winter getaways, only to find yourself wondering if you should sell it before the next political shock or currency swing wipes out your returns. That's the tough decision thousands of Canadians are facing right now as geopolitical tensions, economic uncertainty, and currency pressures reshape cross-border real estate investing. In 2025, we're seeing a clear shift. Canadian pension funds and big investors are rethinking their U.S. real estate exposure. Everyday Canadians who once flocked to U.S. vacation homes are cashing out, sometimes in droves. The numbers, motivations, and implications tell a fascinating story about how international real estate strategies are changing. Why the retreat from U.S. real estate is happening now. For decades, the United States was the natural first choice for Canadian real estate investors. Close proximity, similar legal systems, and plenty of warm weather destinations. But in 2025, several forces are pushing investors to step back. One, geopolitical tensions and Trump's tariff threats. The return of Donald Trump to political prominence has brought renewed talk of tariffs on Canadian goods and a harder U.S. stance in trade negotiations. While these policies don't directly target real estate, they create broader uncertainty about U.S.-Canada relations, which in turn makes long-term investment strategies riskier. 2. Diplomatic strain. From disputes over energy pipelines to differences in foreign policy, the diplomatic relationship has been under pressure. Large institutional investors, such as pension funds, are wary of sinking capital into a market that could see future regulatory or tax changes targeting foreign owners. 3. Economic diversification goals. Canadian pension funds, which manage billions in assets, are increasingly looking to Europe and Asia for diversification. European real estate markets, particularly in Germany, the Netherlands, and Spain, are viewed as offering both stability and growth potential without the same political volatility. The great U.S. vacation home sell-off. It's not just institutional players making changes. Everyday Canadians are unloading U.S. vacation properties at a pace not seen in years. What's driving the sales boom? A weaker loonie. The Canadian dollar has been hovering at lower levels against the U.S. dollar, meaning owning and maintaining used property has become far more expensive. From property taxes to HOA fees, costs have effectively risen 20 to 30% in Canadian dollar terms over the past few years. Rising maintenance costs. U.S. homeowners associations, insurance premiums, especially in hurricane-prone states like Florida, and property taxes have all surged. Some owners have seen annual carrying costs increase by over 25%. Since 2022, political instability, polarized politics, changing state tax laws, and evolving property regulations have left some Canadian owners uneasy about the future. Pandemic-era reversals. During COVID-19, Canadians flocked to U.S. vacation homes as a lifestyle investment. Now, with travel fully reopened worldwide, more owners are exploring other international destinations rather than being tied to one property. The numbers paint a clear picture. According to data from U.S. real estate boards and reported by Business Insider and other outlets, listings of Canadian-owned U.S. vacation homes have doubled or even tripled in certain popular markets since mid-2024. In Florida, Arizona, and parts of California, Canadian sellers now make up as much as 10 to 15% of new listings in some resort communities. Demand from used buyers remains healthy, meaning many Canadians are able to exit profitably despite the market headwinds. Where is the money going instead? The capital freed up from these sales isn't necessarily staying in Canada. Many investors are reallocating toward European property markets. Countries like Portugal and Spain remain attractive for lifestyle and rental income, with golden visa programs adding residency benefits for some buyers. Domestic opportunities. Some investors are shifting to Canadian vacation markets, like Muskoka in Ontario or the Okanagan in BC, where currency risk is eliminated and travel is simpler. Emerging markets, while riskier, regions in Southeast Asia are attracting interest for their high rental yields and growing expat communities. The emotional side of selling for many Canadians. Selling a U.S. vacation home isn't just a financial move, it's an emotional one. These properties often hold years of family memories, holidays in Florida, golf trips to Arizona, or winter escapes to California. But as financial realities shift, sentiment is giving way to practicality. Owners who once planned to keep their properties indefinitely are finding it makes more sense to rent abroad when desired rather than carry the ongoing cost of ownership. What this means for the broader market. The Canadian pullback from U.S. real estate could have ripple effects. In the U.S., resort and snowbird markets may see shifts in buyer demographics as Canadians exit. Domestic buyers and other international investors could fill the gap, but the pricing and pace of sales may adjust. In Canada, repatriated capital could fuel domestic investment in both residential and commercial properties, potentially adding competition in already tight markets. Globally, Canada's increased interest in European and other overseas real estate could further diversify global investment flows. Looking ahead, will this trend continue? If geopolitical tensions persist, the loonie stays weak, and U.S. property costs keep rising, the sell-off is likely to continue through 2026. However, if currency conditions improve and the political climate stabilizes, we could see a return to cross-border buying, though perhaps not at the pandemic-era pace. For now, Canadian investors are in risk management mode, prioritizing markets that offer stability, currency advantages, and predictable regulations. Final thoughts. A new chapter for Canadian real estate investors. The retreat from U.S. real estate marks a significant shift in Canadian investment behavior. What was once considered a no-brainer buying property in Florida or Arizona now comes with enough financial and political risk to make many think twice. For some, this is a chance to explore new markets and diversify in ways they might not have considered before. For others, it's a bittersweet farewell to properties that once symbolized freedom and sunshine. Question for you. If you had the choice today, would you invest in used property, look overseas, or keep your money in Canada? Let's hear your thoughts in the comments.